If you are an investor, these couple of questions have probably crossed your mind once or twice. How do you tell when a stock market is actually overvalued? Or are the prices unreasonably too high? Am I supposed to wait for the market to go down or should I just jump? And these are very crucial to ask. Obviously, who in the right mind would go and gamble their stocks and money into the market that's on the way down the drain? Yeah, that's not exactly the kind of situation you were hoping for. But don't worry, because today we will get into key indicators that you can use to figure out whether or not a market is overvalued.
Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started.
Let's get started with the concept of the market PE ratio. I'm sure you'd be familiar with PE ratio or price to earnings ratio by now. Did you know you can actually get the PE ratio of the entire market as a whole? And the data you can get can be a helpful indicator if things are overvalued. Don't get it quite yet? Well, let's go deeper. In the United States, they have an index that they call the S&P 500. This S&P 500 is a measure of 500 different companies in America and their performance. These are usually very large and highly known enterprises. This index is what the entire market in the US generally engages in. This is also known as a benchmark for their market as a whole. What you do is that you get the price of the index, which is how much stocks are or their raw cost. Then you compare it to the earnings, or basically the profit you get from the stock selling. You will now have your cost versus profit ratio. It's been a classic benchmark use. Now, how do we get the numbers? Easy peasy. Just get the old fashioned internet browser and type in the website multiple.com. There you will find a visual graph. You will see that the current S&P ratio is at 32.95. When you put it in comparison with numbers in history, it's quite higher than your average figure, which is actually 15.85. It is currently double the average, which can be taken as a warning sign considering that this rate is quite similar to the 1999's S&P. And that, my friends, was just before the dot-com crash. So, looking at these similarities, the current state of the market might be overvalued. But of course, there are still a few indicators that we have to put into consideration. Indicator number 2 is the Schiller PE ratio. There have been quite a number of investors who have critiqued the traditional PE as a measurement for the market. Their argument is backed up by the fact that earnings in particular years can fluctuate due to business cycles, making the ratio a bit unreliable. That's where we'll introduce Professor Robert Schiller. He is the one responsible for developing what we now call the Schiller PE ratio. To break it down, Schiller was able to compute the average earnings for the last 10 years while adjusting it to inflation as well. This takes the market fluctuations out of the picture, creating a more accurate measurement for the market. So naturally, a lot of investors trust this mode of measuring the market more than the traditional way. Moving on, we're now going to talk about another indicator, which is the Buffett indicator. We're pretty sure his name rings a few bells since he is just the biggest and most successful investor of all time. He also has a reputation of not being able to time the market and instead keeps his eyes on quality companies during market sales. Buffett also has a formula to see how the market is doing, what's its value, and if it's something worth buying. In a Fortune magazine interview, he said that it is probably the best single measure of where valuations stand at any given moment. Now, what exactly is this formula? Well, the Buffett measure is the market cap of corporate equities divided by the nation's GDP. To break it down, it's the total prices of stocks compared to how much they are producing in terms of goods. So right now, the Buffett indicator is blinking at 171.7. That is pretty high, even higher than what it was during the housing bubble crash in '08, as well as the dot-com market crash. Buffett explains that the indicator before the dot-com crash should have been a very strong warning signal, and perhaps it should be the same thing today. Bottom line is, you look at these corporate equities and see their prices are high. You put this aside to side and what these equities are actually producing. Or in other words, you compare it with the actual state of the economy, which is not looking so pretty. So you can see the contrast between the prices or stocks with how the economy is doing. And this is the reason why Buffett indicator is a big figure. Now, the ultimate way of determining whether the market is overvalued or not is here. You have to compare and contrast the returns you are getting in the market with the returns you are getting in other asset classes. Either way, if something is overvalued, you need to compare it somewhere to get a corresponding hypothesis. This is exactly what the next method will show us. The first step is determining the return that you can currently get in the market. For some beginners, they might say that this seems impossible, but what they don't know is that it all takes one calculation. Can you recall what we calculated earlier for the PE ratio? Well, we'll be using that one. If you can remember it correctly, the current market PE is 32.95, meaning that is equal to the price divided by the earnings. This time, let's switch it upside down and get the inverse formula, which is earnings divided by price. So once we divide 1 by 32.95, we get 3.03%, which is the earnings of the price. Just like when you pay $100 for a stock in the market, you would be able to get $3.03 back. That is a 3.03% return. Although there is one factor we are missing, which is growth, it's a given fact that earnings will grow over time either way. So how do we compute for growth? It's simple as looking at the growth rate for the past years or so and assuming it into the future. To start it off, you Google US GDP growth and you will find the rate somewhere between 2 to 3%. That's accounting for the past 5 years, give or take. With that kind of data, we can assume that it will be relative in the coming years. What can we do next is add 2.5% of growth to our return percentage of 3.03%, summing it up at a 5.53% of return. That means this is the return rate that you can receive if you buy stocks in the US market. On an average rate, you would be getting a 10% return in the US, at least that has been the average return per year in the 20th century. But because prices have gone up at a high amount, the return has decreased exceedingly. Well, we all expect that since the higher you pay for something, you expect the return to be a little smaller. Basic fundamental business. Now that we have established that the stock market return in the United States is around 5.5%, what about other asset classes? They are all relative in one way or another. Besides the stock market, we all need to put our money somewhere anyway. It could be cash or whatever form. But what investors like to compare their things to is bonds. Bonds and stocks are the two main forms of income that investors tend to concentrate in. You may also have real estate, but it just doesn't attract investors compared to the latter. So what we usually have is bonds or even your money in the bank versus the stock markets, and just our luck, it's much easier to get returns for bonds. All you need to do is open the CNBC website and head for the 10-year Treasury bond. And if you notice, it's sitting at the very low number of 0.86%. Irregardless of whatever you want to compare it to, that figure is significantly low if you look at it through history. But it doesn't stop there. When you look at the 2-year Treasury, it gets worse. It sits at 0.16%, almost nothing at this rate. So once you have your money on bonds, the return you are getting is quite a low rate. This is similar to banks, which at the most gives you a 1% return annually. And the feds are to blame, since they are the ones who are managing the interest rates and have set them as essentially low as they can go before it becomes negative. Once we look at this from an investor's perspective, you can spot some indicators that flash warnings that the market is being overvalued. Naturally, you can expect a 5.5% return from current prices versus the 10% return that you normally would have. Then you go look at the other asset options, which are banks and bonds. But that's where you actually lose money due to the higher comparison of a 2% of inflation, compared to the not even slightly 1% return of the banks and bonds. This is why investors would rather invest in stock markets despite the price being extremely high. They look at the bonds and banks as dead ends if they want to see successful return in their favor. The only shift that can change things is if interest rates goes up, which is why it's important to look out for that one. So here we have it, the methods that great investors have been using for years now in order to analyze the scope of the markets. We may not be fortune tellers, but a little help to predict the market may be the magic that we need. Oh, and invest wisely, kids.
Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.